Welcome to your favorite finance podcast, Opening Bid. I'm Yahoo Finance executive editor Brian Sozzi. Now let's make some money and get a lot smarter. Here with me now is FedWatch Advisors founder and chief investment officer, Ben Emmons. Ben, good to see you and congrats on the new firm launch. I know it's been a long time coming, and I also just realized I told people that this was their favorite podcast, and I'm hoping it is. Maybe you could help us drive that message home.
Absolutely, Brian. Good morning. It's really great to be on.
So I'm going to lean into your firm's new name, FedWatch Advisors, which I really dig because I'm a Fed watcher, and I know there's some tools out there on the internet that lean into FedWatch. But my first question to you is really tied to a note by the folks over at Citi that is making, I think, some waves here on a lot of trading desks. They are contending, Ben, hang with me here, 8 rate cuts through July 2025. To me, that would be a rate cut bonanza. Do you see that happening?
Yeah. That's truly a bonanza, and that seems unlikely. We know how Powell and the rest of the FOMC is really thinking about this, that their level of rates, they have to sustain a little while longer because they need that confidence that the inflation is really moving down. And what you looked at from the minutes and also at that monetary policy report on Friday, they make a lot of emphasis on that it's not enough progress yet, it's too slow of progress. And that means that rate is restrictive, but it's never been sufficiently restrictive or overly restrictive. Because if that was the case, then Citi is right. There would be a bonanza of rate cuts following, because a real restrictive rate would bring the economy down on its knees quick, and that's never happened. What we're going through now is just a soft patch, I think, just a temporary slowdown. If you read that monetary policy report right, they talk a lot about slowdown in exports, slowdown in some of the manufacturing construction, slowdown in somewhat in spending, but it's all very moderate. But there's word emphasis on moderate. So as long as the Fed is in that thinking, moderate slowdown with inflation gradually moving to the target, there's not going to be a bonanza of rate cuts. That's the reason. I don't disagree with Citi that ultimately that could happen if the economy flips on its back. And hopefully it doesn't happen, but if it does, then that is definitely the outcome. But 8 rate cuts is also not priced by the markets. It's more like 3-4 rate cuts over the course of the year. That seems more realistic, I think, at this point.
I think that's a really good point you just made. If the economy flips on its back, and that's what I want to follow up with you here on, because what gives you the confidence the Fed is going to get this right? They are waiting for, it seems like, this number to be hit on inflation. 2% is their preferred inflation gauge? And they want to hit this number. Where is it to say that they will not be really behind the curve on cutting rates? And by the time they do decide to cut rates, we're looking at a U.S. economy barely growing, or dare I say, even in a freaking recession.
Yeah, that is, of course, a risk. And they do have said that that's something they keep in mind, right? If they're too restrictive in policy at this point, that will be the risk in the future. You're again behind the curve with cutting rates, but it's easier to cut rates than to lift them, though, right? That's, I think, one big difference compared to what they had to do in 2022. They had to get off the sidelines much faster than they realized, and then really throw in big slugs of rate hikes. The opposite is easier. In fact, March 2020 is a good example of how they brought rates down immediately to zero. Right, so if there were a true calamity, the Fed has a lot of tools in the box to address the issue. So I think the economy stays here on track, partly because, and this is really important, I think, Brian, to another topic, is that it's really fiscal policy that's driving it. We don't see any material change in fiscal spending, and no matter who will be president, the new president will come in with an agenda to stimulate the economy. And if that's the case, then the Fed cannot do much other than just go really slow on rate cuts if they can. And I think that's the scenario ahead of us.
Before we came on and started chatting, Ben, I was drinking my, 7th cup of coffee and an energy drink, my usual modus operandi in the morning. But a really interesting op-ed by Ken Chenault and Robert Rubin in the New York Times discussing a potential second Trump presidency and how it might be dangerous to the economy. I have a couple questions in that I want to ask you, but do you think a second Trump presidency for the U.S. would be dangerous to the economy? Why or why not?
Yeah, it's an interesting way of thinking of it because, first of all, markets never vote on a particular candidate, right? They just look at the agenda and make a calculated probability saying like which agenda will actually succeed. And there's more things to it. Let's say that President Trump would be reelected. He does confront a Congress that could be split. It could not be a Republican Congress, could be a divided one, which makes it for him harder to implement everything, specifically tax cuts. Secondly, the tariffs that he has in mind, although that would be untried, I think, a universal tariff. It all depends on how other countries react to that tariff. And it also depends on how domestic producers adjust to these tariffs. A lot of mixed evidence on this and how the previous trade policy affected the economy. There were job losses in certain sectors. There were tariffs passed on by 100% in certain product categories, but it was not completely across the board. So that's to be seen. And lastly, what's interesting, every time that President Trump is sort of being touted as the new president, there's some sort of animal spirits lifted in the markets. Interestingly, that happened after the debate. For example, too, there's something about this great "Make America Great Again," the slogan. And again, I'm not here saying that President Trump will be the next president or make any suggestion thereof, but it's more like observing as an analyst, saying this is an animal spirits response in markets that see sort of this investment, lower taxes, friendly climate of deregulation, that sort of thing, really, spurring the economy. And I think that is actually the positive side of the agenda. And by the way, you could say the same about President Biden, by the way, but he may continue with all the fiscal spending that he has in mind. And people have said, like, at some point too, that will become problematic because of the deficit. It also could become problematic because of, again, inflationary pressures re-emerging. So I think for both candidates, that's the key issue. How will inflation actually re-emerge as they come into the White House for that term? And I think that's the biggest risk, I think, for the economy and the markets. And that's not, for now, market expectations are that the Fed will reach its target and mission complete. So if any of these policies that they enact, Trump with his tax cuts and tariffs and Biden with his fiscal policy, if that does lift up inflation, I think that's the biggest risk for both candidates.
All right, well, I will be more fair and balanced here, Ben, because I really don't feel like getting raked over the coals on YouTube. I suspect I will anyway, but nonetheless, are both of these candidates dangerous for the U.S. economy? Let me just tick through this. You have President Trump, potential universal tariffs, more tax cuts, raises the deficit. Maybe President Biden in a second term pushes through various green new agendas that acts like a tax on corporations and U.S. households. I mean, it's just the bottom line is that come 2025, the U.S. economy is going to be in a totally dangerous position with whoever's in the White House.
Yeah, the deficit is the magic word there, right? The magic word, because people look at the UK, what happened there, right? Of how it was ill-timed, the policies, and then the market reacted to it. Although I think in the United States, it's a little different story, though. We know the deficit is large. We had last year in the summer a bit of a test of that idea where it really came down to like, how is the Treasury going to fund this big deficit? And it may have to extend the maturity of its debt in order to do so. And that drives up interest rates and then therefore could slow down housing and slow down investment. And I think this is the challenge here, that you have a large deficit. How much more can you truly add to it that the Treasury has no choice but to fund it with long-term bonds that then have to go up in yield to get demand for those bonds? And I think this is really the crux of the US situation, at the risk and the danger that you talk about, as opposed to a particular candidate by himself affecting the economy really negatively. As I mentioned, I think the animal spirits around former President Trump are really interesting, how markets respond to it. But also with President Biden, markets have been very responsive to the investments in the economy and what it does to semiconductors, which have been such a driver of markets over the last year. So I think it's more about the deficit, how will the Treasury fund it? And that refunding idea, that's been an ongoing sort of lurking risk against, as a last point, we do have a debt ceiling that comes up in January of 2025, which is like, I think, a week after the president sits in the White House, that process starts. And let's not forget that in June of 2023, when we were negotiating that debt ceiling, that the yield on Treasury bills, like the safest asset, went up from something like 3% to 7%. So there was something in the markets about this debt ceiling is a negotiation about what you're going to do about this deficit. You're not doing anything about it. Rates may go up because, yes, you're going to have to fund it with more debt and longer maturities. So that's, I think, the key risk.
I'm going to stick with my word of the day for just one more moment, Ben, and that is dangerous. And the last thing that really stood out to me in this New York Times op-ed is the potential for the removal of the Fed chief should President Trump win. Now, of course, President Trump has been very vocal, doesn't seem to be feeling Jerome Powell and everything that he has done. But within that story is a mention by Peter Navarro, very, let's just say, a hot button person in the world of finance, to say the very least. He suggests that Trump may remove Jerome Powell within his first 100 days. Frame this for us. How dangerous would it be to remove a Jay Powell early on in a second Trump presidency? How dangerous for the economy and how dangerous for markets?
I think what markets are looking at is that Jerome Powell's term is going to end in the next, I believe, 2 years. So it is in the cyclical horizon. And the way the structure of the FOMC works, it is still a body of say, democracy, so to speak. It's not just the chair that drives the entire decision making. And you have, of course, the vice chair, Jefferson in this case, who could step in temporarily as acting chair. And it's really more about transition to a new chair. So if you think back of the previous transitions that we had, say when we went from Greenspan to Bernanke, and from Bernanke to Yellen, and Yellen to Powell, I mean, what markets typically try to frame is about how dovish or hawkish will this candidate be, this new chair. People know Volcker was the most hawkish chair. Powell, in that sense, is being looked as very pragmatic at times, and somewhat hawkish, but also flips to dovish. I think those will be the considerations for markets. But if, say, that Powell were to be, quote unquote, removed, it's not so easy, by the way, to do that. There's congressional hearing and Senate hearings about it before that actually could happen. And it's to be seen if that actually happens. But let's just hypothetically say that Powell just steps down. I don't think markets will react negatively because they look at the body of the FOMC, but they will extrapolate out who will be that next candidate. Will it be a really dovish candidate? If that's true, people will start pricing and easing, right? And they start looking to Citi's report and say, hey, that is going to be 8 rate cuts.
All right, Ben, hang in there. It's time for a quick break. Don't go anywhere. We'll be right back with Ben coming up. All right, Ben, welcome back here to Opening Bid. Of course, we were scaring the hell out of people with dangers to the economy and the markets. I mean, there's a lot going on. And look, we're obviously not trying to scare anybody, just trying to lay out what could be coming at investors months and years ahead. But you and I were talking about something real quick before we came on, and that is just the state of the markets. Despite all the dangers we have outlined here, the election, various geopolitical risks, you still have a market that has touched, the S&P 500 that is, 34 records this year. What is going on?
That's amazing, right, Brian, that we are in that stage, because as we were talking about, we get all these elections, UK, France, and now upcoming election in the US, lots of uncertainty, trepidation, and lots of movement, and how will the governments look like. But as you can tell, markets have taken it like these are risk-on elections, so to speak. That meaning, there is actually not really going to be major change in policy as a result. It's not going to be flipping from one side to the other. UK is really a good example, right? How Labour just regained a massive majority. In the case of France too, it flipped from far right to far left, and net coming out basically with no risk. And the French sovereign CDS, that's basically a good risk measure for France. Risk of defaulting is dramatically narrowing in spread now. So. And same for the US. After the debate, people concluded well, there's a good shot that former President Trump could win the White House, so we know what's going to happen, and all the uncertainty disappears, and the volatility goes down, and the stock market goes up. I think that's what it really is about. People want certainty, and they look at these elections like these are becoming more certain outcomes, and that's why we're getting this low volatility, risk-on feel in the markets like we're seeing this morning.
You called me out also before we came in for checking out your LinkedIn profile ahead of this. Look, I'm preparing for the segment, Ben. This is what I do. I got to prepare. I got to look online for things. And, on that search, I ended up going through a few different tabs and mentioned somewhere, I forgot where I got this. At 16 years old, you witnessed the 87 market crash. And are there conditions in place in today's market that remind you of that 87 crash? And do you think we could be on the precipice of something like that happening? I'm calling out record high valuations, I see Tesla up 8, 9 days in a row for really no apparent news. Nvidia over a $3 trillion market cap. To me, it feels like an expensive market that doesn't deserve to trade where it's trading at.
Yeah, and that valuation does matter, as I mentioned, but I also think it's about, ultimately, it's a macroeconomic trigger that makes people aware of that the market is or was too expensive. And then the realization sets in that you have to get out of these expensive names. Lots of comparisons have been made between NVIDIA, let's say, and Cisco in the 90s as an example, which are two very different companies. And it just generally the idea of like where AI is versus the internet time, the startup internet period in the late 90s. There's definitely some level of froth is there. There's a lot of liquidity in the market. You see speculation through this the sector called meme stocks, right? That's happening. We know that volatility may be on the lower end of the historical range. If you read again, boring report perhaps, but the monetary policy report from the Fed has always some interesting nuggets in there. There's a whole section about financial stability. One thing that stood out to me is they're making, again, a reference to what the hedge funds are doing. They have more leverage on than they had several years ago. They have this huge, what they call basis trade on, which is like playing basically the Treasury futures versus Treasury bonds. That seems to be a massive trade. I think if I think of that, for example, as a former trader and PM, when I was really involved in that type of trades, those are like very murky areas, that are unknown how exactly it's going to unwind. I think also the Japanese yen is another example in that context. Yen is at the weakest level in almost 40 years. And the yen is always used as a borrowing mechanism for taking risky bets in other assets. It's called the yen carry trade, the technical term. How that's going to unwind against this valuation issue that we're seeing in the stock market, which could get even richer, by the way. It could be even more expensive before it actually unwinds. So I do agree that the 1987 analogy, maybe to an extent there. We obviously have high frequency trading and algorithms and other issues today that could trigger that really quickly. That's happened before, flash crashes and that sort of thing. But at the end of the day, it's a macroeconomic reason why it all unwounds. And to our earlier discussion, what's the risk to the economy from here, right? The deficit, the tariffs, the different combination of these policies ultimately trigger an effect in the economy that's negative. That's what we're actually waiting for, and we're not seeing that yet until it does. And people watch jobless claims, and the unemployment rate as one reason to be careful. Like if it goes up too quick, too fast, the economy is flipping on its back, right? And then the trigger is there, and all the unwinds start to happen. So I think as an investor, you would look at these risks as they're there, they're on the list. We know what they're to an extent about. On the other hand, you just got to invest today, right? And what's the opportunity? Well, the market is in a good spirit, so you should invest, not be sidelined.
Ben, you scared me a little bit because you did not say, Brian, you're a dope. We are not going to get a crash. I'm listening to what you're saying, and to me, it sounds like there are conditions in place, notably the hedge fund leverage aspect too, in the high frequency trading. But how do you go upon spotting a potential crash? How does the average person even do that? I look at the average investor, they have their 401ks, they're sitting on maybe a lot of wealth in NVIDIA, Apple, various tech stocks. They don't have the access to tools that certainly that you have in your experience, but also the tools and access that I have.
Yeah, I think the really easy, simple way for people that do not have access to these tools to just look at the statement and look at their position in NVIDIA, say that they have that, and look at how much percentage that position is today versus, say, when they bought the stock 3 or 6 months ago. And if there's a significant difference in that percentage, so say that their position in NVIDIA today represents 15 or 20% of the portfolio, and a few months ago was just 5%, that is a sign of like, see, this is becoming quite frothy.
Yeah,
And you
cash
should
in,
try to,
cash in on the Nvidia. Go out and buy yourself a
right.
Lamborghini. No, but really, you have to.
Yeah.
You shouldn't have. To your point, you shouldn't have most of your
Right.
portfolio in Nvidia, right?
That's right. You should never have it in any single instrument, no matter what company it is, or even a treasury bond for that matter, because that is called concentration risk, and people may not realize that they have that in their portfolio. So they should carefully look at it. Like, if something is like, I would say, you have a 20%, 30, 40% position in one single asset, whichever one it is, you should take action because that's too much concentration risk. Now, what's the ideal percentage? lots of research on it. People have typically said anything between 2 to 5, 7% type of position. That's reasonable if you have other positions. But I would never have a position that's so large that it dominates the entire portfolio performance. And that's, I think, what people should look at in their statements if they're listening to that. As opposed to, yeah, I got all the tools, I can analyze all kinds of things, but I would look at the same thing. And I do that in my own portfolio. Like concentration risk in one name is a serious risk to your retirement.
Of course, Ben, you have all your wealth tied up in NVIDIA, correct?
No, I am diversified, but you're right. Like it is phenomenal, phenomenal opportunity to be in, and it is obviously major. Yeah, it's a phenomenal era right now that AI is an old technology. Right? It's from the 70s. It's now become so mainstream. And so much money is put into it, right? That's why these stocks are up. It's just the money being spent on it that's driving it. At some point, that spending ends, right? For whatever reason. So just think about it. You can't build your retirement on one particular asset, even though it goes really well for a long time. The other example that you mentioned, like an automaker, Tesla, was another example like that. And there's many others like that. At some point, things change, and just be mindful, right? If you have too much exposure in one particular asset, stock, bond, whatever it is, just be very careful.
Ben, in about 2 minutes that we have left, I just want to channel the vibe of your 2020 book, The End of the Risk-Free Rate, Investing When Structural Forces Change Government Debt. Do you think, because of the rising amount of government debt on the books and what is likely to come in the years ahead, are entitlement programs like a Social Security, like a Medicare, are these things at risk of going away or at risk of major cutbacks?
Yeah, they are, because you're getting this situation of that if you're running a prolonged deficit, that it becomes so unsustainable that you have no choice but to cut those programs, right? And that's the challenge. Besides that, there's estimations that Social Security could run out, right, in terms of being able to fulfill its obligations to retirees, because there's just not enough money left. And even though right now it's making up somewhat on the higher interest that it earns on treasury bonds, so it is a clear risk, but it's also a very difficult political choice that has to be made. We got to cut entitlement spending in order to control our debt and deficits. And that's just like a household idea too, right? You run your credit card to a certain level. If you run it to the max and you don't do anything about it, you're going to have to make drastic changes in your budget. And I think this is something that may be ahead of us. So far, we're banking on that the economy keeps growing, right? And we keep getting like investment, and we're finding other ways to sort of manage that deficit, or the Fed eventually be able to cut rates so the interest burden gets a little less. But from that book perspective, when I wrote it in 2013, the first version, it was around the taper tantrum of the Federal Reserve. There was a recognition that interest rates were too low and there was too much risk. And I think that risk is still today, even with higher rates. There's a lot of interest rate risk in the system. So that is, I think, the other issue here with these large deficits, that interest rate risk will once again be repriced, and you're seeing higher yields emerging in the horizon.
Ben, I've already come to peace that I will not be getting Social Security, and if I do, it might be a check for $10. We're going to have to leave this conversation here for right now. FedWatch Advisors founder and chief investment officer Ben Emmons. Ben, good to see you. Congrats on the new firm launch, and let's hope we don't get those 8 rate cuts by July 2025, like Citi predicts, because we'll probably be in a recession. Ben, good to see you. We'll talk to you soon.
Thank you, Brian. Great to be on.
All right, and that's it for the latest episode of Opening Bid.